The Loonie is again trading below 70 cents US. That's the lowest point for the dollar in nearly 5 years. So let's dig into the reasons behind the dip and bring in Karl Schamotta. He's the chief market strategist with Corpay, a foreign exchange firm for businesses. We reached him in Toronto. Karl, nice to see you. Thanks for taking the time.
You as well. Great to be on.
So how did we get to this point with the Loonie hitting, I guess it's a psychological barrier more than anything, but below that 70 cents US?
Oh, that's really well put. Yeah, I mean, it's been a very long slide here. It goes back really, a couple of decades if we really want to look at it. Essentially, there's about 4 factors that are driving the Canadian dollar's decline. The first is that the energy supercycle that got underway right before the global financial crisis and sort of peaked around 2014. It's over. Oil prices are no longer driving a lot of investment in the Canadian energy sector. We have very, very high household debt because housing prices rose so dramatically over the last couple of decades. Households in Canada are carrying the G7's highest level of household debt. That means that as central banks raised interest rates, the cost grew heavier and households have had less money to spend on consumption, and that slowed down the overall economy. We're having that at the same time that the U.S. economy is outperforming, as you mentioned in the prior segment there. Jerome Powell is talking about a U.S. economy that is clearly outperforming, not just domestic expectations, but also the rest of the world. That means U.S. interest rates are high, and that's making, U.S. markets the best place in the world to park money. And then you take all of that and layer on top Trump's trade threats, his threat to impose 25% tariffs on Canada, and you have essentially a deadly cocktail for the Canadian dollar.
So a deadly cocktail, when you say that, what do you mean? I mean, if Trump follows through with this tariff threat, how low could the dollar go?
I'd say at least a couple of cents lower. So, potentially all the way down to like 67, 68, somewhere in there. Just on the basis that, the export sector would be hit very hard, that consumer sentiment in Canada would weaken substantially, that businesses would slow their investment. All of that would mean that Canada would very likely topple into a recession, and that would have a very negative effect on the currency's value relative to the U.S. as well as other global economies.
So Canada could go into a recession. It could become a lot more expensive, say, to buy, fresh produce from California, right? And for Canadians who maybe travel south, obviously they'll notice the dollar being much lower. So are those the key areas? And then, of course, you mentioned the recession, which also could mean the loss of many, maybe thousands of jobs.
That's, I think, the biggest issue, right? Buying costs might go up a bit. We might have a modest inflationary impulse in certain areas, but the reality is that if Canada is in recession because export industries are laying workers off, the overall effect would actually be downward pressure on prices, right? Prices would go down simply because there wouldn't be enough demand for the products that are on sale. And so, I wouldn't worry too much about, the inflationary effect. I would worry very much more profoundly about the effect, the hit to sentiment, the hit to employment, and all of the dominoes that could be knocked over if that were to result in, a slowdown in the Canadian economy.
Is there any silver lining, and I mean this in the context of if we are in a recession, if these tariffs do come in, if the dollar does go down for exporters who rely on the U.S. market?
Yes, there's major advantages here. And in fact, I would say that this is sort of a correction of where we've been over the last couple of decades, right? If you look at the post-2008 era when the Canadian dollar got above parity with the U.S. dollar, that was too high, right? That was hurting Canadian exporters. That was hurting the companies that are selling goods to the rest of the world. And so, if we do see a correction lower, some of those exporting firms are going to be put in a better position. They're going to be able to sell, cheaper exports to the world, and they're going to be able to grow. And so, this is a bit of a rebalancing process. And apologies if I'm going on for too long, but one of the things that's sort of interesting about all this is that even if Trump, especially if Trump doesn't actually follow through on his tariff threats, the fact that he's weighed on the Canadian dollar so much, that is actually hurting American exporters, right? So to a very big extent, not only is he suggesting putting taxes on American consumers, but he's also hurting the U.S. export sector. So this is an enormous own goal for the United States itself.
Yeah, and then finally, and if there are retaliatory tariffs on the Canadian side, I mean, that could also be bad for American exporters as well, right?
Exactly. And one assumes that if it's coming from Canada, it'll be happening elsewhere in the world as well. So, the reality is that this is not a unmitigated success for the U.S., unlike the way that Mr. Trump seems to be, seeing it and trying to convince Americans of. The reality here is a very, very complex and unfortunate circumstance.
Karl, thank you. Karl Schamotta is the Chief Market Strategist with Corpay in Toronto.